XEQT and VEQT, probably the two most common and most popular ETFs in Canada to invest globally. And recently, BMO launched ZEQT or ZEQT. I don't know how you pronounce Z. I pronounce it Z. Is it just me or do these ETFs sound kind of cute? Get it? Because it's got QT in the name? No? Nobody finds it funny? I mean, ETFs are hot right now. Everybody wants to invest in ETFs. So BMO gave us another option to invest globally. On the surface, they are very similar. All invest in the global market with heavy emphasis on the US market, slightly less in the Canadian market, followed by developed and then emerging markets. All three are ETFs by large financial institutions: Vanguard, BlackRock, and BMO. All three ETFs have a low fee, because you know, fees are one of the most important determining factors in investing in ETFs. Now, these ETFs are designed to be like a one-stop shop, meaning you can basically invest your entire portfolio into these three ETFs and be extremely diversified. Like over 9,000 companies diversified. Companies you and I never heard of. However, there are some subtle differences between the three ETFs. Both XEQT and VEQT has some slight disadvantages which I believe ZEQT doesn't have. So we're gonna break this down into two categories: fees and holdings and diversification. Now, in terms of fees, as mentioned before, all three are low. I would say anything below 0.3% MER in Canada is acceptable for ETFs. Mutual funds, that's another story. Those are expensive as hell, and that's why I prefer ETFs. VEQT has an MER ratio of 0.24%, which is already low, but both XEQT and ZEQT has an MER ratio of just 0.2%. So even though VEQT has a low MER fee, XEQT and ZEQT just wins out. Now let's talk about holdings and diversification. The problem with all three funds, I believe, is that all three funds are very heavily weighted towards Canadian equities. Almost 30% for VEQT, 24% for XEQT, and 24% for ZEQT. The only problem is, Canadian companies only account for like 3% of the world's market cap, which means these three ETFs are way too heavily invested into the Canadian market. So to me, it doesn't seem like they represent the global economy too well. On top of that, all three put heavy emphasis on the US market. Okay, this one I understand, because the US market accounts for about 53% of the world's market cap. So I get it. Now, if we look at the three ETFs and the breakdown of their investments, you know what, it's just my preference. I prefer an ETF with lower distribution into the Canadian market because, well, we only account for like 3% of the global market cap. I'm looking for a bit more diversification. And at 30%, VEQT for me has a little bit too much investments into the Canadian market. But then again, that's just my preference. There is, however, one advantage that VEQT has, is that the US holdings in this ETF is a total market ETF. What that means is, they include small to medium cap companies in the US market, which the S&P 500 doesn't include. If we look at XEQT, it's only the S&P 500. Basically, the 500 largest companies in the US. ZEQT invests a small portion into small markets and medium markets. The thing about small market companies is that they're much riskier. They're basically always on the brink of being in bankruptcy or prosperity. But you know what? VUN, which is what VEQT holds, and the S&P 500 performs very similarly anyways. Cause even though VUN invests in small and medium-sized companies, it's still more heavily weighted towards the S&P 500 stocks anyways. I mean, look at ZEQT. Only a tiny percentage of the portfolio goes into small and medium-sized companies. But it's there. Whether or not that makes a huge difference, that's up for debate. Me personally, I prefer to include small and medium markets in my portfolio. Cause you know, I'm young.
Stop it. Get some help.
Okay, you know, I'm kinda young, so I wouldn't mind taking on a slightly higher risk. Speaking of risk and diversification, I'm looking at the foreign markets between these three ETFs and one thing jumps out to me. Vanguard, because it's so heavily weighted towards the North American market, has less allocations in the non-North American market. Personally, I like to take a little bit more risk. I see potential in emerging markets, cause there's a stronger chance of economic growth potential, which means more risk, at least compared to the Canadian market. And out of all three ETFs, it seems like ZEQT is slightly more geared towards young investors. It's got the lowest MER fee at 0.2%, lower exposure to the Canadian market, holds US small and medium cap markets for more diversification, and last but not least, higher allocations towards foreign markets, especially emerging markets, which I believe has a lot of potential. So if you're young, like me, okay, stop it. I know, I consider myself young. ZEQT might be a slightly better option than VEQT and XEQT. And honestly, it might be the only ETF you need, cause it literally invests in like everything. But then again, all three are like super close anyways. I just prefer ZEQT, and I think my reasons are somewhat valid. Alright, that's it for today. If you learned something from my video today, consider a like and subscribe. It really helps out the channel. I make financial tips for Canadians in my long form content and financial comedy in my shorts. Thank you all, and I'll see you next time.